If I could just start by getting your thoughts on what we're seeing out of Italy. The news flow keeps coming, but clearly the story has been there for a little while. The budget conversations taking place in Rome. From what you see so far, a 2.4% budget deficit, does anything that we see coming out of Italy at the moment threaten to put the ECB off its normalisation course?
So you've packed a lot into that question. So let me say, first of all, that whether it's Italy announcing last night, other governments announcing in the last few days and in the coming days their budget plans for 2019. That basically triggers a process where through the European system, those budgets will have to be assessed by the Commission whether they are in compliance with the various fiscal rules. So I think it's important to think about it in several levels. One is all members have obligations under the European framework to show that their fiscal plans are in line. Now, those rules are complex. There's a degree of judgment, and I leave it for the Commission and the European Council to declare in due course their opinion. Second of all, and as we're seeing this morning, there's also a market opinion. So the market opinion in terms of the impact on spreads and so on, from an ECB point of view or anyone else trying to work out the macro implications, of course, fiscal policy operates through different channels, but one of which is the spread, especially in a situation where whether it's the government or private sector, that has a direct impact on funding costs, on prospects for investment and consumption. So, when we do the next forecast now in December, all of this will feed in. It'll all feed into how we think about the European economy. But of course, when we set monetary policy, that's on the basis of European aggregates. And I think what we've seen so far is it's not the case that the uncertainty about Italy or other fiscal plans at the moment is feeding into some area-wide, some systemic change in the assessment for whether future growth prospects or future funding costs. So, of course, it's a very important country, it's a very important situation, but from a monetary policy point of view, what ultimately matters is how all of that feeds into the aggregate European data. Yeah,
so you'll be you'll be reviewing that European data then in the months ahead, I understand. In terms of the growth story that we've seen out of Europe so far, it does seem as if we've seen a little slowing in growth, whether you look at the French or the German PMIs. And I wonder whether there is a point at which that slowing in growth starts to impact that normalisation process. So park Italy for the moment. The slowdown that we're seeing in growth, is there a danger that it throws normalisation off track?
OK, so I think it's very important to say two things there. One is what we're seeing is a very interesting type of slowdown. So we have to think about there are obvious reasons why in the world this uncertainty has been elevated, say, in relation to trade, for example, in relation to other factors. So there are some demand-side factors. There's also, on the supply side, some parts of Europe starting to hit capacity constraints. So if part of the slowdown is essentially output hitting up against capacity constraints, in fact, if you like, that might suggest to be more inflationary pressures. Because as capacity constraints hit, then the incentives for firms to raise prices, the incentives for wage negotiations to be more positive go up. So in terms of the assessment for inflation, what we're seeing, we think, is quite robust. We think this is confirming that the projections we have, which underlie our strategy, are fairly robust. So my bottom line here is, what we've seen so far, in fact, if anything, is affirming that what we have now, which is still a lot of accommodation baked in for at least another year, in terms of our anticipation. And subject to that accommodation, what we're seeing now is not something that would cause that to be revised.
So despite some of that sluggishness in the growth story, you're still confident in getting to the inflation target over the time horizon?
So what's interesting is we think that's quite a robust forecast that we have. So it's not the case that this is a fragile strategy because there's a lot of accommodation there. Given the big increase in employment in Europe, given the decline in unemployment, especially in some countries, the kind of projection that we have increasing confidence in that.
Mario Draghi at the start of this week was talking about inflation being relatively vigorous. This was core inflation, which seemed to cause a little bit of confusion in markets as to whether this was a new signal or not from Mario.
I don't think it's a new signal, but I suppose people or the markets should listen carefully to what we say, which is that, remember, we set policy for the forecast of inflation over a medium term. And over that medium term, what we think, if you like, is the final leg of the journey towards the target is stronger labour markets, stronger wage outcomes. And as unemployment comes down, as we see more and more countries getting towards a situation where the labour market invites stronger wage settlements in favour of workers, then the final leg of the journey to the inflation target is kicking in. So we see that more and more. Not everywhere, and there's still a long way to go. But as I say, our view is there's more and more evidence that the inbuilt dynamic, the self-sustaining dynamic towards the target is in train.
So if Mario Draghi talks about relatively vigorous core inflation, but with the context that you described there, Governor, we heard from Peter Pratt earlier this week talking about inflation pressures remaining subdued. The market didn't seem to jump on those comments quite so much. So give us your characterisation then, if you would, of inflation.
There's no particular difference between those two interpretations. I mean, it depends on, I suppose, the timeline you're talking about. It remains the case that between now, as of September 18, and let's say 2020, that vigorous underlying engine of inflation has to persist and widen out to the whole euro area. So in that context, inflation remains, as of today, wage negotiations, wage settlements remain in the aggregate not sufficiently strong. What we're projecting forward with all of the forecasting techniques is this will pick up. But all of that is subject to the monetary policy remaining accommodative. So this is why it remains the case that inflation forecast is contingent on the package we have, which helps to keep funding costs low, which helps to keep interest rates low and helps to keep inflation expectations anchored at the target.
And part of that package is that interest rates are low right now, and the ECB has suggested that they will be on hold beyond the summer of 2019. Since that phrase was used, there's been a bit of repricing in the markets, and now it seems expectations are set that perhaps we could see the first hike in September rather than the fourth quarter. Is this just all too far off to know, or do you think the market's expecting too much too soon?
No, I'm sympathetic to the idea there are traders out there who need to make those kind of calls. But exactly, it's a year away. All of this is in anticipation based on the data we see so far. And I think, of course, as we move along, as we get closer towards the end of the summer next year, then there's going to be a more precise debate. But at this point, this is so far away that it's not worth talking about.
OK. Let's talk a little bit about risks. We've heard from Mario Draghi recently talking about risks to growth are broadly balanced. That was the phrase, I think, at the last ECB meeting. But then he listed a number of threats, whether it's emerging markets or protectionism, financial market stability. Which of these or any other is looming largest in your mind? Which of the threats to growth and the growth story looms largest for you?
So let me say what we have at the moment is the market essentially being, I think, relatively balanced in their views of these things. So if these risks turn out to be less severe than expected, then that could be an upside risk to the growth forecast. So, for example, if it turns out the trade tensions fade away, if it turns out that the Brexit outcome is OK, on all of these fronts, if we get an OK outcome, that's more like a positive shock to growth. On the other hand, if those go badly, then we have clear downside risk. I mean, I think everyone, will agree that ultimately the trade risk is, if it happened to be a severe trade war, that would have a big negative impact. But whether that is very likely, it's hard to assess. But let me emphasise with the emerging markets, because I think this is been the big point of the last few weeks, is everyone always knew, as the world entered a tighter monetary regime, as the Fed started raising rates, there would be an adjustment process. That adjustment process can be relatively stable, with maybe some isolated stress, as we've seen in countries like Argentina and Turkey, or it could become rockier. And that's really, I think, the biggest risk, is the emerging markets are such a big part of the world economy that as of now, we don't think this is a risk that's going to materialise because the market stress has been relatively contained. But given the size of emerging markets in the world economy, anything that puts the emerging markets under excessive strain is a big problem.
Okay.
I don't see it, but hypothetically, it's a risk.
Okay, and you're clearly very interested in what all of this does to the data that the ECB pours over at all of their meetings. And that leads me on to a question around your role and the ECB. There's been plenty of talk as to who's going to fill various open positions in 2019, including the job of chief economist. Any thoughts on whether you're in the running for this position at this time?
Well, as you know, there's a lot of speculation about all sorts of jobs at the ECB and elsewhere. As you know, as an applicant last year for the vice presidency, and so as you might imagine, I stand ready if the Eurogroup, the European Council, looks in my direction. Of course, I'm interested if that. But equally, there's many strong candidates out there. And I should emphasise the job I have is a great honour to have. I'm fully committed to the job I have. So it's not the case that this is something that occupies my days.
Okay.
Of course, Europe has to find replacements for the very strong group we have right now. Let's see what happens in the next year or two.
OK, and given the job that you do have now, if I ask you a little bit more about Ireland, just to finish off then, Governor, house prices in Ireland dropping in the past month because of tighter mortgage rules, some are suggesting. We're still some 19-20% away, I think, from the peak of house prices before the crisis. Is that an acceptable drop-off in house prices we've seen?
Let me say, I think this is very good news. So I've signalled for a while that, in fact, another factor behind the flatlining at the moment is more supply coming onto the market. There was a real shortage of housing investment after the crash, and as it's going slowly, but it's moving, and as more housing becomes available, that helps to relieve the pressure. There's a lot more to go. There's an affordability problem in Ireland. A lot of people are paying very high rents, can't find a house to buy. So the fact that house prices are either flatlining or coming down a bit, I think is generally good news.